Uganda's economic outlook remains dim as the shilling continues to slide against global currencies, precipitating the risk of debt distress for a country with a voracious borrowing appetite. During a recent budget conference, the finance minister, Matia Kasaija, spoke candidly about the threat of creeping debt.
Almost every Monday, cabinet sits every Monday, there will always be a new demand. And now I have learned to be polite and keep quiet, even when the president said, "Yeah, Kasai, you're going to find the money for this." I say, "Excellency, yeah." Then I come back, I don't do anything. Because the money is not there. Either you deprive a sector in order to give money to another. The money is not there. I cannot borrow indefinitely.
Catherine Kijagulwe, the head of trading, Absa Bank Uganda, revealed to NTV the extent of the shilling fluctuations.
We have seen the shilling opening the year 2024 at levels of 3775, 3785. As at Friday, 23rd Feb, it's trading at levels of 3935, 3945, about a 4% depreciation from where it opened the year.
She further attributed the depreciation of the shilling to the ripples in the early stage of the financial year.
A number of factors have contributed to the weakening of the shilling, though it was accelerated in the past 2 weeks. When we had the infrastructure bond in Kenya, we saw some offshores coming to purchase dollars with the shillings that they had, or selling part of their holding in government securities, converting it to dollars, and then going to invest in the infrastructure bond in Kenya that was interest-free and cleared at 18.4%. So that led to a significant depreciation in the currency.
She's optimistic that the shilling could gradually emerge out of the volatility.
Usually between this time and June, we see a number of companies paying out dividends, which also leads to the depreciation of the shilling. Then also, as government spends, of course, paying suppliers, then some of those who import goods will also have the liquidity to be able to purchase some dollars. But then on the other hand, the supply side is also well covered. We'll see the commodity exporters being able to sell dollars if the coffee season comes through around March, also to be able to match off some of this demand.
Madina Guloba, who is a senior research fellow at the Economic Policy Research Center at Makerere University, shares similar views.
Compared to the quarter of the same issue last year, the performance is almost similar. So what we have to understand, what happens in these few months, January to March, that makes the exchange rate the way it is, because the behavior is a bit similar.
Madina further attributed the depreciation to the weak position in regard to the country's balance of payments.
Export prices have actually plummeted down a bit, because we see the coffee price being not so good right now in the foreign markets. We have cotton, which has also not performing so well. I think you can see even recently tea. Tea has misbehaved.
John Kakunguru Walugembe, an economist, unpacks the causes and drivers of the shilling's depreciation.
So the issue is that we are importing a lot, we are exporting a little. It's like a household that sells one banana but buys 2 bunches of matoke every day, buys 2 kilograms of meat. You're spending more than you're actually earning.
Dr. Amos Sunday, a researcher at EPRC, looks at the implications of this shilling fluctuation at a granular level.
If you're a country that borrowed 100 billion, say 100 billion shillings, you'll have to pay 5 billion more in debt, just due to exchange rate depreciation. But if you are also a private business person who borrowed in dollar terms, you will pay the same. So it increases the cost of borrowing to the business community, and also at macro level, it increases debt burden for the country. But also in terms of imports, so depreciating shilling makes imports expensive, and the importers or the business people will have to pass over that to the common person in terms of higher prices.
While Ugembe says at the moment, the actions of Western central banks have had an influence on the exchange rate fluctuations.
There are investors out there, maybe pension funds or whatever, that will come in here, purchase government securities and so on because of the higher return. Okay? But at the moment, because of global inflation, Western central banks are raising interest rates. All of a sudden, the returns they would have made here, they can make back home. And it's a more secure investment environment. So most of those portfolio investors are pulling their capital out of the market. This is having a negative impact on the strength of the shilling.
The ruin left by the COVID-19 pandemic has pushed Uganda to breach borrowing thresholds as the principal and interest for its debt in this year's budget rose exponentially to 17 trillion shillings, an astronomical figure which will likely erode the gains made by government-generated revenue. This has affected Uganda's overall credit rating by Fitch, an American credit rating agency, which stands at B+ with a negative outlook. The negative outlook reflects Uganda's weak external liquidity position and challenges to its access to external concessional financing and grants related to concerns about democracy, human rights, and corruption. This could lead to borrowing at higher interest rates and fewer options in terms of lenders willing to provide credit.
Most of our debt is denominated in dollars. So it means we need more money to pay our existing debt. First off, already we are, if you look at our public debt stock, the Auditor General says it's about 90 trillion now. So, this is huge. And we run a risk of debt distress if you're not careful. You see? So, not only are we going to find it more difficult to service our debt, our existing debt, but it means we shall also have to contract new debt because, as I've told you, the dynamics that I've just mentioned to you mean that we need to fill in the gaps, except if we can cut down our expenditure significantly, which is unlikely.
However, it must be said, a weakening shilling does offer opportunities.
A weak shilling per se is not a bad thing overall, always. A weak shilling means that imports become more expensive because if you want to import, if our shilling is weak and you've been importing things worth 5,000 US dollars, means you need more Uganda currency to purchase the same things. So it discourages imports. So it helps moderate our trade deficit somehow. But at the same time, it makes our exports more competitive. So for the people who are importing from Uganda, Ugandan products become cheaper. So it means that it can also be a way in which you can boost our exports. Of course, if you're not exporting significantly, then it means that advantage does not accrue to us.
In June 2023, the government rolled out austerity measures, including a freeze on the creation of new units, the reduction on domestic borrowing, and the merger of government agencies, which it estimates will result into saving about 1 trillion shillings. But the government has already reneged on its promise to scale back on domestic borrowing. In the last financial year, government borrowed 3 trillion shillings from domestic banks, which will likely crowd out the private sector from the credit market.
There's a lot of borrowing. This is happening from government to the commercial banks and taking up almost all this to consolidate some of the resources they have to pay off some of the debts or to even make the budgets functional in terms of development financing or recurrent financing of the budget. So you find that at this point in time, probably with times of the way the donors are working in now, you find less resources coming in now. So government is increasingly looking out for commercial banks to finance its business.
The Finance Ministry's report, released on January 31st, 2024, attributed the depreciation of the shilling to the rising demand for the dollar in the sectors of manufacturing, oil, telecoms, and energy. It also indicated a deficit in domestic revenue collections in January 2024, amounting to 2.2 trillion shillings, lower than the month's target of 2.3 trillion shillings. This shortfall was mainly on the account of lower than anticipated collections of VAT, excise duty, and taxes on international trade. According to the February 2024 Bank of Uganda Monetary Policy Statement, instability in the Middle East is creating new supply chain disruptions and the threat of higher oil prices. In addition, the risk of heightened volatility in the global financial and foreign exchange markets remains, which could spill over into the domestic foreign exchange market. Indeed, the recent shilling movements against the US dollar have been mainly driven by external factors and, if sustained, could lead to higher inflation despite easing global inflation. Furthermore, renewed global supply disruptions could reverse global disinflation and delay monetary easing in advanced economies, leading to continued portfolio outflows and further depreciation pressure on the Uganda shilling, reads the statement released by Michael Atingi Ego, the deputy governor of the central bank. However, on a brighter note, in December 2023, Uganda traded at a surplus of 22.3 million US dollars with the rest of the EAC partner states, a shift from a deficit of 22.6 million dollars recorded the previous month. The expanded scale of borrowing was predicated on the expectation that the government could generate 10 billion US dollars in the oil sector during the final investment decision. But the investment outlook remains gloomy amidst flack from the West towards financing fossil fuel projects, which may pose a threat to biodiversity in favor of clean and renewable energy, a claim which the Ugandan government says is flawed as Western countries contribute the largest amount of carbon emissions globally and have failed to honor reparations to poor countries, especially those in sub-Saharan Africa. Left with few options to sustain its budget, the government continues to expand its borrowing portfolio, which will likely peak at 100 trillion shillings, as the government plans to borrow 13 trillion shillings this year to plug the deficit in the 2024-2025 budget. The Auditor General John Mwanga, in his 2022-2023 audit report, warned that the increasing trend in the government debt position reduces the available resources for both funding development projects and service delivery, as huge resources will be directed towards debt repayment. At the domestic level, the COVID-19 pandemic heightened borrowing led to the collapse of private firms and small and medium enterprises. Till to date, properties which had been staked as collateral to secure credit at commercial banks are being foreclosed and sold under the hammer. Symbolically, if Uganda was a private firm, its financial metrics and its debt-to-equity ratio would be worrying, and it would cease to be a going concern. Experts predict that government technocrats can only reverse the trajectory of falling into a debt trap by adopting strict austerity measures and fiscal discipline.